All right, everybody, welcome to the Red Door Property Management Podcast, where we are going to bring you several new segments here. We've got a lot of things popping off here in the local community, in the real estate market in general. I am joined with Mike Taylor, broker owner of Red Door Property Management. My name is Chris Knight, business development manager here with Red Door. And let's see how Mike's doing today. Mike, how's it going?
Doing good. Well, I'm better. We traveled over spring break and I got a chest cold, which then turned into pneumonia.
Yeah.
But I am on the mend. So if you hear me coughing here today, that's what's going on. But I am doing better. I'm feeling good. The sun is shining. It's like mid-April. It's ready to rock for leasing season. I'm super excited.
Yeah, you've been on the mend for like 2 weeks. Yeah, so
I
I don't know what on the mend means these days, but
You can still hear it.
yeah, you can. Yeah. So excuse him, audience, as we go through this, and he has to hit the cough button every once in a while, or if we'll just try not to get him too excited here as we go on. But
Yes, that's right.
welcome to the podcast. Again, we've got a couple new segments where we're going to get into this week's property management question of the week. So we're going to get into a few of those, which the ones I have this week were a little, at least one in particular was a little bit triggering to me. So we're going to get into it. Whether it's going to be a great topic of discussion, only time will tell. But as we get this kicked off, we're going to start with some economic news that's happening, or that is that Mike or myself feel a little bit more passionate about, or we feel like our investors or new investors to the area need to be informed on when exploring this market for their next asset. So I'm going to jump into that with one that we have. Well, actually, both of these we've kind of discussed. One is a little bit more of self-interest because if you've watched the podcast here recently over the last 2 months or so, I have indicated that I believe we're going to be leaning towards more of a buyer's market than a seller's market, although the numbers that we're going to get into might or might not indicate that. You'll have to stay tuned to determine whether that's the case. But here we go. Now, this is brought to you by fastcompany.com, which indicates, and these news articles have been popping up in my feed all over the place, Mike, and I know this was one that you were going to bring up as well, but it's housing market shift. Out of the 300 largest metro area housing markets, 60 of those markets are seeing falling home prices on a year-over-year basis. And this is according to some club monthly analysis that I've never heard of. But again, I'm getting alerted by this from all different news cycles. And that's, I mean, I don't need to dig into this article. I just wanted to point out that I'm right. You know, I'm obviously right. This is clearly indicating the direction that I was feeling. Who's got his finger on the pulse? This guy. All right, Mike. What's your take?
You and I have a little bit of a disagreement on this. I don't think that it is going to be this huge buyer's market that you're portending. There are some news articles that say, hey, existing home sales are slipping and new home sales are slipping, but actually, some of the market data that we're about to show in our monthly market report actually maybe goes a little bit into contrast as far as the local market. Now, I'm not saying the national market that you're wrong, but I mean, that's why it's so important to stay in tune with the local market, because what's happening here in Indy may not be indicative of what's happening in, maybe the Sunshine State and things like that, that maybe were a little bit more boom and bust. I mean, we're a little typically, Midwest, Indianapolis is typically more, tried and true, not as much up and down, just, slow and steady kind of wins the race. So I think that's where we're heading. Actually, let me show you something, Chris, that's actually going to completely and totally burst your bubble for the March data for the sales for Indianapolis. Let me share something with you here. Give me 1 second, okay? Let me pull this up.
Yeah, let's do it. All right, that sounds good.
All right, so what I'm going to show you here, if I could figure this out.
Mm-hmm.
This guy here.
All right, here we go. It's popping up.
Okay, are you seeing it?
Got it.
Okay, so this is a graphic that we actually used to talk about. We used to bring it up until we broke out all of the individual cities and submarkets and made it even a little bit more granular. But this is comes from MyBor. This is MyBor's, they call it snapshot. So this is for March, and this is for all of MyBor's service area, which is central Indiana. Okay. But two things of what I want to point out to you, and this is again March's data. Actually, three things I want to point out. The number of closed sales, 2401. That doesn't mean anything, but in terms of month over month, that is a 29% increase over February. Now, some of that's going to be seasonality, but a 29% increase is absolutely huge. And then median days on the market is 12. That is incredible. That's down 42% month over month. And median sales price is up just slightly, 1.6% month over month. But really, the number that I want to highlight here is the number of months of inventory. This is such a good indicator of the health of the market, whether it's a buyer's market or a seller's market. And a 1.6 month of inventory is nothing. So that, and look at that, that's down 23% month over month. So that is telling me that we're still in a seller's market. I mean, a 1.6 month inventory of homes and 12 days on the market, that is super, super indicative that we are here locally in Indiana still very much in a seller's market.
That's crazy.
So, isn't that nuts?
Yeah. That is crazy. Down, what does it say? 25. It's a small graphic here on the screen. 25.4%, I think is what it says there for your month's inventory. Wow, that is crazy. And again, just to give you a little bit of a tease into the market reports we're about to get into. I mean, it does indicate. I mean, we just glanced over them. We tried to have real reactions here on the cast. So we try not to get into too much, but it was obvious that was a glaring indicator on this month's market reports that something was going on in March. So we'll get into that here in a minute, but you may be right. You may be right. You know what? I'm talking to people here on the ground, and the conversations I'm having is with people's properties that are sitting, trying to achieve the price point, the imaginary price points of super high dollar, and they're just sitting. It's the consumer trying to secure the information that they have heard 3 months ago, and so they're just late to try and achieve that high dollar price point. I think. I don't know. We'll see what happens. And then not even to mention, and this certainly is never going to evolve into anything like a political podcast, but you can't ignore what's going on on the political landscape and all of the hesitation that is inevitable to create on the real estate market. So if I didn't even know about any of the numbers, I would probably lean towards that's going to create a little bit of hesitation in the real estate market for at least the near future.
Yeah, I mean, when you introduce that much volatility, and it's volatile out there. I mean, from tariffs to interest rates to, I mean, there's just a lot going to the stock market, taking these wild swings, day in and day out. I mean, there's so much uncertainty that definitely causes people to hit the pause button, delay that decision, stuff like that. So yes, all those uncertainties definitely paralyzes a lot of people.
Yeah. So if we dissect that just a little bit more, sorry if I interrupted you there, but if you talk about the tariffs that are coming in regards to steel and stuff, that could result in a slower home building process, which I am reading that home builders are having to have major incentives in order to unload some of the new construction that they already have up and on the market. But if those tariffs alone are fully enacted, then that could create a slowdown in home building, which obviously creates a short of supply, which increases overall prices. So that is a factor here as well.
It's definitely a factor. I mean, who knows what's going to happen? You know what I mean? It's
It's
one thing one day, it's another thing another day. I mean, I've heard up to 25% tariff on timber. I mean, certainly timber is a huge factor going into houses. That's going to have an inflationary effect, at least on new construction, which will then probably have an effect on existing home sales as well. So I'm not super confident that we're going to see the bottom fall out of the market. I think prices are going to continue to creep up is kind of my suggestion, what I've been saying. I think I'm sticking to those guns.
Okay. All right. Well, we'll see who's shining at the end of this their second quarter. Maybe getting into third quarter.
All right. Hey Chris, I got one more to share with you. Unless you got another one.
I was just going to talk about some of the local ordinances that have been enacted. So if you got something, let's hear it.
Oh yeah, we need to talk about that. Yeah, let me do this one real quick. And so, we're always reading articles and getting stuff in our email, and that's what we do. So, one of the articles that I got in my email was Bigger Pockets. Everybody knows Bigger Pockets, right? Huge blog about real estate investing. One of them was here. I'll just share it with you again. Okay, it is like the top 3 markets to invest in 2025.
Oh, here we go.
And
Here we go.
I'm not sharing it with you because Indianapolis is on this list, although I think the case I'm going to make is that it probably should be. So top 3 cash flow markets in 2025. Okay. Do you remember when we used to talk about this? That's not what I wanted to do. Are you seeing what you should be seeing?
I think so. The top 3 cash flow markets in 2025.
Perfect. Okay. So really what this is an analysis of is the rent to price ratio. And I mean, back in the day, we've both been in this a long time. You remember when it used to be, the 1% rule where all investors wanted to get a home that would rent for 1% of the purchase price, right? And those days are just gone. They just are, between increased prices and all that stuff. That's just gone. But anyway, so I thought this was super interesting. So, they highlight 3 different ones: El Paso, Texas. The other one's Columbia, South Carolina. The other one's Tuscaloosa, Alabama. Okay. And they go on to say the median rent price, and then the median rent, and then the rent to price ratio. Okay. So back in the day, a great property would be 1%. Well, now we're looking at 0.6%. And this is according to Bigger Pockets. This is what the ratios that, they're calling out that are good ratios, right? So his top 3 are 0.6. Columbia, South Carolina is 0.60. And then Tuscaloosa, Alabama is 0.62. Okay. Now, I did this real quick and dirty spreadsheet of the numbers that we report for March for our Indianapolis market. Okay. And this is not going to look very pretty, but here is our rent to price ratios. Can you see this spreadsheet I'm looking at?
Yeah, I can see it.
Okay. So remember, they were 0.6, 0.61, and 0.62, I think. If you look here, average rent in Indy, average sales price, that gives you a rent to price ratio of 0.69. Almost every single submarket is at or better than what they just called out as the top 3 cash flow markets. I mean, Indy's are almost 0.7. Look at Westfield, what 0.72.
Oh, it's
Lebanon,
beautiful.
0.71. I mean, everything is at least around that 0.6, 0.60. And that's not even like looking hard for a good deal. These are just averages. You know what I mean?
Yeah, those are beautiful numbers. That's fascinating.
I just thought it was fascinating.
Yeah, that is absolutely fascinating. Yeah. So that's factoring your average sales price, average rents. So there are so many other factors that you have to be looking at when you're talking about a good deal rather than what they're throwing out there. I mean, that's interesting. Yeah. And
Isn't that crazy?
Yeah. And there's so much more commercial development that's happening in this area than I would imagine that's happening down in Tuscaloosa, I think, was one of your markets.
Yeah, I think Tuscaloosa. Yeah.
That's fascinating. I love it. I love this breakout, man. We should use that graphic that you've created there. That's beautiful.
Yeah, it was nothing special, but it just real quick, just put something together quick and dirty, just to say, hey, look, almost all of Indianapolis is already better than their top 3. And we haven't even like really scoured to try to find anything super special. So anyway, Indy has been highlighted as a great investment market, and just a quick graphic to show you why.
There you go. That's Indianapolis has been given the cold shoulder by these top. I wonder what Tuscaloosa is paying Bigger Pockets to market that community. No, Indianapolis is your market that you need to be a part of. That's cool. I'm glad you put that together. That's fascinating information.
Yeah.
Well, I think you had Fishers on one of those markets that you were indicating there, and that takes us to what we were talking about last month, maybe even the prior month, about this potential local ordinance that they were going to put into place on local neighborhoods, where they were going to cap it at 10% of the entire neighborhood that had the ability to rent out their property. So they were going to cap it at 10% of the homes in a specific neighborhood was the cap on available rentals in a specific neighborhood. So, well, that has come to fruition. So that has been passed, and that is scheduled to be enacted as of January 1st of 2026. So not only has Fishers gone ahead and passed that, but this is now a new development in the city of Carmel. They are moving towards enacting a very similar ordinance that with very few exclusions, being military, job relocation, things like that. So there is still a potential if you are in these markets and you have a potential new job change or something like that, where you may not be stuck and you may still have the ability to rent out your property. But nonetheless, this is a changing market. Now, one new development even since then is that the state legislators have been quickly moving to block these local communities from having the ability to enact their own individual ordinances on local homeowners. So, what's your take?
God, I have so many different feelings on this. So, one, if I own a bunch of homes in Fishers, I love this because you're limiting my competition, right? Two, if I'm thinking about purchasing a home in Fishers, I'm probably racing. Well, I mean, I'm going to wait and see what happens with the state, right? If the state trumps them and then they can't do it, then it's game's over. But if this does pass and the state is unable to, then honestly, I'm looking to purchase some homes in Fishers because with a rental cap, I mean, that's huge. I literally have a cap on my competition, which is great. I don't love it for the future because I don't think it's great. We're more of a renter nation than we ever have been. And I mean, I get the sentiment behind it. It's, in theory, it's driving more competition, which is potentially driving up prices, but not everybody wants to buy a house nowadays. I mean,
That's right.
I think on one of the podcasts we did, like the average person now waits to buy a house until they're like, it was something crazy, like 37 or 38. Is that what it is?
That's right.
So we got to have inventory for people to rent as well. So I don't know. I don't love it in theory, but if I have homes in Fishers, I do like it, but I don't want to have my ability to purchase additional homes limited by the government. So, I mean, overall, I don't like it, but I can see some advantages to it if you already have them. But what concerns me is that if it passes and the state doesn't, I think all the communities are going to follow suit. I mean, you're going to see Westfield, Noblesville, all those people, all those municipalities, I would guess they're going to follow suit and pass something very similar.
That's exactly what the state legislators are concerned about. That's why they're taking action, I think, before it gets too far out of hand. And you're right. I think immediately the only people I see that it probably benefits is if you already have a few properties in that area. You're probably fairly excited right now, and you're not looking to expand in that particular market. But yes, let's talk about why that this was even of consideration. And so my perspective or perception is that they are trying to prevent these very large conglomerates from coming in here and swooping up a whole bunch of properties because they not only do they increase prices of these homes in the area because they're picking them up so quickly, and they're typically cash buyers, so their terms are a little bit more favorable when they're acquiring properties, but that when they rent out the properties, they're not taking very good care of the properties long term. The lawns are getting weedy, the bushes don't get trimmed as often. Whatever the case may be, they're caring for the properties like they should. So that's the idea of trying to prevent again, large institutions from being able to pick up properties like that. But to your earlier point, I think it does limit. I mean, we're a lot of people aren't ready to buy or just simply can't buy in today's market. Yep. So now they're prevented from even entering a great community like Fishers or Carmel because they don't have the ability to purchase a property, and the rentals are going to be limited in that area. So, which is only going to create rental competition and probably increase rental prices. And that obviously, yep. Right, with limited supply, you're going to see increased rental prices in that market without a doubt.
Or more apartment complexes, and I don't know anybody who loves apartment complexes. You know what I mean? All you hear about is people complain about, not in my backyard. I don't want those apartment complexes in my backyard. But if you don't have houses to rent, people need to rent. They need to have inventory to rent. So that's going to increase apartment
prices too. Apartment prices. Those prices are going to go up for an apartment. So I'm not in love with it. It's definitely something we're going to need to watch over the next coming months. So make sure you stay tuned to the podcast here so that you know what's going on a month-to-month basis. We'll be sure to keep you informed as that continues to develop. That's about all I've got on
potentially big news, though. I would say we're going to stay on top of this because that if the state, if that state law passes, like I said, game over for them. But if it doesn't, I mean, that's huge news. And It's like April, still time to react in terms of picking up some investments before the end of the year. And that's what I would do if honestly, if Fishers was able to pass this. I would try to pick up a couple, 2, 3 more in Fishers if I was an active investor. So still time to react, but definitely stay on top of it. We'll definitely be reporting on this for sure.
Honestly, I mean, if you're looking to pick up properties in any community, even like that, I mean, if this is a concern, I'd be picking up properties in other suburban areas, even similar to that. So
Yeah.
Noblesville, even Westfield, a lot of these areas I'd be looking at because, like Mike alluded to earlier on, is that these other communities are going to start enacting very similar ordinances if the state doesn't do anything against it.
Yep. Yep.
Okay. All right. That's going to wrap up our economic news for this part of the podcast. Next, we're going to get into this week's property management question of the week. So that's the segment we're going to get into here now.